This is Boom Bust, and these are the stories that we're tracking for you today. We're talking wage growth here on the show today, specifically wage growth here in the U.S. And at the center of the debate is, of course, the Fed. We'll tell you what's going on and what to expect coming right up. Then we're bringing you part two of my interview with Peter Joseph. Now, we got a ton of feedback, both positive and negative, from part one. And part two promises to be just as exciting, so you can't miss that. And it's the end of the week here on Boom Bust, which means it's viewer feedback day on the show. Edward Harrison and I address your questions, comments, and concerns live on television. You won't want to miss a moment, and it all starts right now. Here in the U.S., the latest debate about the economy has to do with wages. And at the center of the debate is, as usual, the Federal Reserve. You see, the Fed has kept rates at zero for 5 years now, and the Fed's balance sheet has ballooned by 5 times in that same period. Now, regardless of how the economy is doing, many Fed watchers, increasingly uncomfortable with Fed policy, are calling for monetary tightening. Now, the Fed began dialing back its QE program in December at a pace of $10 billion per month. That puts the Fed on course to end QE by the end of this year. But the question is, what next? Well, the next step is rate hikes. But then the question becomes, when? If you look at the futures market, the markets are expecting the Fed's first rate hike to come in the fall of 2015. Rates would then rise by about 1 percentage point per year as the Fed normalizes policy. So far, so good. But hold the phone, not everybody's on board with this one. And this is where the wage issue creeps into the discussion. Now, see, wages have stagnated over the past 3 decades, and workers, on average, are earning no more each week in inflation-adjusted terms than they did in 1979. Now, meanwhile, household debt has skyrocketed. In the 1980s, aggregate household debt was just under 50% of U.S. GDP. Now it's well over 80%. Now, most economists are seeing this divergence between household income and household debt as unsustainable over the long term. But there is no consensus on what to do about it. That's the problem. Now, some economists are saying that we have to rely on the Fed to work its magic, and the Fed needs to keep rates at zero until wages eventually increase again, and as the economy moves closer to full employment. Other economists, on the other hand, are saying that much of the unemployment rate is structural, meaning that those without jobs simply don't have the skills that the job market requires, and we're a lot closer to full employment than the Fed suspects. They believe that the Fed needs to raise rates at the rate that the market expects, if not faster. Now, who's right? That's the critical question for the U.S. economy. How close are we to full employment? There it is. Critical question. If the doves are right, then the Fed's not listening to them, and tightening too soon will weaken the U.S. economy, putting all that household debt back into view. But if the hawks are right, then inflation could start rising a lot quicker than the Fed expects. It would be forced to hike rates more aggressively, precipitating a recession. Let's hope for our sake and everybody else's that the Fed picks the right horse to ride. Money. It's been around for thousands of years in one form or another. In fact, according to economic historian David Graeber, historical records in ancient Mesopotamia around 3200 BC show a well-developed system of money and a complex credit system as well. So, naturally, most of us see money as a necessity and a sign of civilization, but not Peter Joseph. He sees capitalism as a failure and wants to return to a time before money and eliminate private property. Now, I spoke to Joseph, founder and leading light in the Zeitgeist Movement, about his controversial view last week, and we heard the first part of that interview then, and it sparked a ton of commentary, which we love to hear always, and we want to show you the second part of our conversation with him now. Now, I started off by asking Peter to explain why he thinks our current economic model is doomed and what differentiates his view from Malthusianism. Here's what he had to say.
Well, Malthusianism is based, again, on that that deep, dark view that there isn't enough to go around. Now, people have been saying this for pretty much millennia. I mean, there was actually BC historians, philosophers that were talking about resource depletion back then. So there's a fear attribute that's been occurring. Malthus, of course, said that there's a geometric increase in population when more resources are provided, but yet resources increase arithmetically. So with that, you automatically assume that you can justify the billion people starving. But that is technically disproven because of the more with less ephemeralization. Here's a word that I suggest people look up, coined by a brilliant engineer, social thinker, R. Buckminster Fuller. Ephemeralization has to do with the fact that we, as we have progressed our technology, can do more and more and more with less and less and less. And again, this is one of the additive contradictions, or I should say the contradiction of the additive nature assumed by capitalism once again, that says we're going to produce more and more and more and more efficiency or more and more produce. That means we have to have more and more people and more employment. Exact opposite. Technological unemployment is an exact result of this exponential increase of information technology that's allowing us to do more and more with less and less, which is why the real true core of the unemployment crisis on this planet, especially in the West, is not the state interference or anything else. It's the fact that we're finding more cost efficiency with using machines that can run 24 hours a day in many cases, no plant shutdowns, no insurance and everything else. So I hope that makes sense. So the Malthusian premise is utterly outdated and completely wrong, by the way. I mean, poor populations reproduce much faster than wealthy populations. It has to do with education, and it has to do with a number of factors that I won't go into, but it's actually completely incorrect.
Peter, what is the doomsday scenario to this money-based economy, in your opinion?
Sure. Well, I think that there are about 3 nails in the coffin. There's the debt crisis, which is wholly hilarious if you look at it in abstraction. We have the S&P, for example, said that by 2040 we're going to have pretty much 60% of all countries insolvent. Actually, most countries today are already insolvent if you use traditional standards of credit ratings and agencies that you would apply to the individual. The United States has been insolvent for many decades. This debt, there's at least a couple $100 trillion in public and private debt in the world that is literally impossible to be paid back because it's about 10 to 20 times more than the actual money in circulation on the planet. So that's going to be hitting the, well, you know the old phrase, it's socialism for the rich and market correction and capitalism for the middle class and the poor. That also applies to countries. So the United States will continue to float into empire status along with the other first world nations with their excessive and incredible debt, while the other nations will be held subservient. The World Bank will come in, they will apply austerity, which basically makes them slaves eventually to the upper class of the countries, just like it happens in the person-to-person basis with third world labor and exploitation, sweatshop wages from Nike, for example, because the people in those areas don't have anything else, so they'll take 8 cents an hour. So the debt issue is a huge problem. Then there's the energy crisis. The demand for energy is going to double within the next, I think, 2 decades. We also have another billion people coming. We also have an immense water crisis, as I mentioned before. These things, if you want to see real social destabilization, let's not resolve any of these issues. If you want to see another world war, let's not resolve any of these issues. The core driver of major overall doomsday scenario situation like this will be the 3 nails in the coffin. The final one I forgot to mention is unemployment, which is related to technological development, and it's called the contradiction of capitalism by some social theorists. And this basically means that we want to use cost efficiency, we want to save money, we're going to keep applying mechanized labor, which is increasing exponentially, especially the service industry now, which is being quickly replaced by AI in many different ways and automated systems. And eventually you're going to have to keep moving people around the new sectors, and we're going to run out of sectors. You know, the great Luddite fantasy is they assume that there's a one-to-one correlation, that technology will create jobs as fast as it's replacing jobs. Absolute nonsense. The human brain cannot learn and adapt as quickly as our exponential increase in technology, and the profit motive will be, ironically, the thing that shuts this system down and reduces purchasing power due to mass global unemployment. And what does that mean? It means social destabilization once again. And the final thing I'll mention, of course, in concert with these 3 issues is the complete and utter environmental disregard. It was reported by a UN-affiliated agency in the late 90s, if I remember, no, 2002, that we need 27 more planets to meet demand by 2050. 27 more planets.
Wow.
If we were to continue the rates of consumption. So And I will add one more thing because of the neurotic obsession with this American dream. Do you have any idea what would happen if the rest of the world actually achieved what the United States has with its incredible resource consumption and its incredible use of energy and everything else? If the rest of the world achieved that, which is what they're trying to do, which is what China's been trying to do, which is a complete ecological collapse in many ways, the entire system would continue to disintegrate into nothing as well. So I take this from a few different angles, but I'll stop there or I'll keep rambling because it's a very exciting subject to me, and I'm very concerned about the future of the planet.
Me as well, and I want, you kind of touched on this before, but I want to revisit it. Many people, they talk about technology creating greater income inequality in society, as we know. How would you deal with that problem in a non-monetary based society like you propose?
Well, I think a further description of what this new social system that the Zeitgeist Movement is proposing would need to be explained, because inequality, it's a complex subject because what defines stratification? What is class? I mean, somebody who is a very low in the socioeconomic ladder, that's a janitor, say, at a school, might be the best softball player on his team in his hometown. So the class relationship and status comes in many different forms when it comes to human society. And the elimination, the creation of economic equality, meaning the ability to create an access society where people can have access to everything that they need, bypassing the hyper-acquisitive neuroses that we've conjured up to keep our consumption economy going, of course. You have to have sustainable values if you want to have a sustainable society. And I look at people that have large, huge, enormous mansions and 2 jets parked in the front lawn as a form of violence against the general population because it's unsustainable on the whole. But that's, of course, for another subject. So the core issue to me when it comes to stratification and class relationships is that if we really want democratic, democratic balance. Everyone in the world wants to think they're in a democracy and think that their voice is heard. They want equal participation in their society. If you really believe in that type of idea, then why not demand economic equality? Why not demand the fact that, yes, everyone should have all their basic needs met. Everyone should have access. We should create a new social order that actually builds upon the ability to create an access abundance, which has not been the case, I'm sorry to say, since before about 20 or 30 years ago. So this is a major paradigm shift, huge, massive. We are able to provide for the entire species to meet human needs and beyond without the need to compete and fight. And if there's anything that I would put forward out there is for people to really think about that idea as the great transition of thought, that we can take care of everybody. We can do it. And it's going to get better and better. And if we only accelerated it by not keeping the market system in its general inhibiting capacity to preserve efficiency, to preserve scarcity, which is what drives the economy, then we can elevate to this new level.
That was filmmaker and founder of the Zeitgeist Movement, Peter Joseph. Time now for a very quick break, but stick around because when we return, we're bringing you the best of the best from this past week. Plus, Edward Harrison and I are tackling your viewer feedback in today's In the Margins segment. But as we head to a quick break, here, look at some of your closing numbers of the bell. Stick around.
Patients are force-fed.
Two explosions near the finish line of the Boston Marathon.
More than 1,000 people have gathered.
What is the latest that you're hearing about the number of victims?
We welcome Aaron Aid and Abby Martin, 2 of the terrific hosts on the RT network.
Boom Bust, it's going to give you a different perspective.
Give me one stock tip.
Oh, never. I'll give you the information, you make the decision.
Tell me about how breaking the set works.
It's a revolution of the mind, it's a revolution of ideas and consciousness.
Are you frustrated with the system?
Yeah, extremely.
Your politics would be described as angry.
I think I'm a strong female.
Are you single?
I've got a quote for you. Let's make it tea time. Stay away from that story. Let's get this guy elected. Let's smear that guy. Instead of working for the people, politicians and the mainstream media are working for each other. Bribery, staged events, bias, propaganda. I think I'd rather play alone.
This past week, we had some great guests on the show, as usual. So it's time now for our Best of the Best segment, where we show you some of the top highlights from this past week. First up is Dennis Gartman's thoughts on the meltdown, not just in Mr. Copper, but in a number of industrial metals. Then we have Jim Rickards giving us his take on the structural issues in Japan as they battle deflationary demons. Plus, we've got Thomas Pally on wage growth, or lack thereof, and the capture of the economics profession, which now seems to believe wage growth is just wage inflation, and it has to be stopped. You won't want to miss that one. And we round it all out with John Molyneux and his take on Japan, too. He thinks the currency is headed to 200 yen to the dollar, and he wants to pay off his mortgage with it. Take a look. Let's look at commodities. The CRB Commodities Index is staging a return on the back of a rally of ag commodities like wheat and corn, but Dr. Copper is telling us something different. Now, that chart looks weak. What do you make of this dichotomy?
Well, first of all, let's take Dr. Copper and let's take his PhD away from him. But let's give Dr. Copper a master's degree in economics. Let's give tin, zinc, aluminum, and copper in aggregate a PhD in economics. And I must admit, of the things that I watch, the fact that the base metals are acting as poorly as they are in the course of the last 3 weeks does cause me some concern. It's clear that I think the economy is doing better. It's clear that I think not just the United States, but Europe and Asia are going to be doing better. But the one caveat is the base metals, the PhD in economics that tin, zinc, copper, and aluminum have is causing me some concern. The fact that copper prices have fallen as sharply as they have in the past week and a half is disconcerting. I will blame a good deal of that upon the problems in the lending institutions in China, who lent a lot of money on copper as a bit of collateral, and with the default last week by that small Chinese company causing some concern, banks have been saying, you know what, we don't like lending money on copper as collateral, and they've been tossing that collateral overboard. Nonetheless, all four of the metals have been weak, and that is bothersome to me.
So the question is deflation over in Japan?
Well, I don't think it's over because, as I said earlier, it's structural. In other words, yeah, if you print enough money, the way to understand inflation, deflation is that we sort of have both at the same time. This is true in Japan. It's also true in the United States. So you've got deflation, which is the natural consequence of a depression, and the world has been in a depression since 2007. Japan has been in a prolonged, very long depression since 1990. So the world is in a depressionary state, which is basically deflationary. On the other hand, you have very stimulative monetary policy, all this money printing, which is typically very inflationary. But a lot of the critics have said, you know, gee, we're going to get this awful inflation coming from the Fed, and that hasn't turned up yet. We haven't actually seen that much inflation, despite the money printing. Well, why is that? Well, it's because you've got this deflationary force. So it's sort of a tug of war. You've got deflation pulling this way, inflation pulling this way, but they're kind of evenly matched. And so you don't actually get much change in the index. Now, the question is, in the price indices, the question is what happens when one side or the other wins? If deflation wins, you could have very rapid deflation. If inflation wins, which should basically be a change in behavior, psychological change that increases the velocity of money, then inflation could take off and spin out of control, as it did in the 1970s. So the tricky thing for investors, obviously, Aaron, if you knew whether we were in for inflation or deflation, you would know how to position your portfolio.
Very well.
It could, right, exactly. It could go either way. Now, I don't think the inflation is going to go very far in Japan because the deflationary forces are so strong. They're also structural, and they also have not been addressed. You've got a demographic weight in Japan, but you've got other problems as well. They propped up all their big banks. You know, you go back to 2009, 2008, you could hear Bernanke saying, we're not going to make the mistakes of Japan, referring to the 1990s. Well, guess what? We've made every single mistake that Japan made. You know, banks that should have been shut down were preserved. Assets that should have been written off were left on the balance sheet. The whole thing was locked in place. It was propped up with government guarantees and money printing, but it shouldn't have been. It should have been allowed to collapse, and then from that you can get new banks with clean balance sheets, restructured banks, and then the economy could grow from there. So we've actually repeated the mistakes of Japan. It's no surprise that we're not growing very well.
Last week, University of Oregon professor Tim Dewey, he wrote a post that seemed to indicate that over the past 30 years, the Fed tends to tighten before wage growth accelerates beyond 2%. Now, I want to throw up this chart so that you can see it too. Here we go. Now, wage growth and federal funds rate. Now, what do you make of this idea?
Well, I think Dewey is absolutely right. That's the facts, and it's speaking back into this financialization narrative. The Federal Reserve abandoned a commitment to full employment, essentially, in the late 1970s, and shifted to focusing on low inflation. And underlying it was this, its justification came from the economics profession, which basically said the Federal Reserve can't do much about employment.
Right.
And therefore, all it should do is focus on what it can do something about, which is inflation. And that's dead wrong. It turns out that not only can the Federal Reserve do something about employment, but when you focus just on inflation in this way, you end up squeezing wages and shifting the distribution of income from wages to profits. So that's how the Federal Reserve and what's gone on over the last 25 years has fed into this financialization issue. And this is what we have to hope for, and this is where we have to keep the eye on the ball now. Maybe Chairperson Janet Yellen is going to be a different policy operator. We need to put pressure on her to make sure that she does not step on the brakes before wages start to increase.
It's going to do precisely what Abe and Kuroda-san wanted to do. If you fast forward to 2012, 2013, and you're Abe, and you look at the problems that Japan has, and you go, oh my God, what do we do? And the only thing I think they could do, among their choices of disasters, is to monetize the debt, which is what they're going to do. They're going to move that massive government debt that you were just referring to, which is probably going to be closer to 250% by the end of this year. They're going to move that off the books of their banks and their pension funds and so forth and onto the balance sheet of the central bank. And what that's going to do is it's going to flood the world with yen. We're going to watch, I believe, the yen go to 200 over the next 5, 7, 10 years. I mean, to the point that I'm closing a mortgage on this apartment that I'm in right now sometime finally next week. It takes forever.
Congratulations.
And then I'm going to turn around and I'm going to basically swap the whole thing into yen using options. And because I think that the yen is going to 200, and my full intention is to invest a little money and to let Abe and Kuroda-san pay for half my mortgage over the next 7 years.
There you have it. I want to make a quick note. Dr. Copper, not Mr. Copper. I accidentally said Mr. before, and I do not want to rob Copper of its PhD. So clarification, Dr. Copper. But there you have it. That was Boom Bust, best of the best from this past week. Time now for you to talk to us. Here we go, in the Margin Time. Margin Tiempo with Edward Harrison. We happen to do this at the end of every week, and we're doing it for you right now. Now, every Friday, Ed Harrison and I take your viewer feedback, and we put you, the viewer, into the driver's seat, letting you steer the show with your comments, questions, and concerns, all sent to us throughout the week via Twitter, YouTube, and Facebook. Now, the first comment comes from Bam Bam 12 after watching the show with Dr. Thomas Pally this week, and he writes, quote, "He seemed to be reluctant to admit that food products are being reduced in size because the dollar doesn't buy as much. He says it's a profit thing. I don't believe that. Ice cream came in quarter cartons forever." Quarts? Yeah, quarter. What are
quarts.
Quarts. I don't buy a lot of ice cream, you can see. And then all of a sudden, it's now 1.5 quarts. Same thing with orange juice and cereal. Eggs are $2 a dozen. This isn't profiteering, it's weakening of the dollar, which the government has been working on for the past 5 years. Ed, thoughts, comments, concerns? What do you think?
Yeah, I mean, like, what did
shrinkflation?
you think of that? Because I thought it was kind of muddled, you know, because basically, you know, it has nothing to do with the dollar and what the dollar buys. It has to do with the fact that if I'm paying the same amount of money for something that is now less, then you know, I'm paying more for that.
Yes, I think shrinkflation is the thing. I like it. I like the term. I think it's a fun term. It's a real term. And there's a part of me that, you know, from a dietary perspective, it's a good thing, but from an economic one, it ain't that good. It's kind of where I stand.
The question is whether or not, you know, the company is pocketing the extra money.
Right.
I think this is what Pally was talking about, or whether or not they're passing through costs. Now, if they were passing through costs that they have no different profit margin, that's different. So that's the problem that I have with that particular comment. I think it's a little bit, you know, it needs a little bit more.
Right. But we thank you for sending it regardless. Now, the next comment comes from the same show from Halo with a zero bend. Clever. Who writes, why not get rid of the Fed altogether? Your idea of asset reserve requirements are predicated on the Fed as being some benevolent institution, which it is not. It needs to be put out of business, which is what cryptocurrencies are in the process of doing. Ed, thoughts? Cryptocurrencies? I mean, they were in the process of doing.
Well, you know, let's take it two parts. Okay, the first about the Fed being put out of business. People probably would be shocked to know I'm not really that big a fan of the Fed. I think that really the Fed, in terms of manipulating interest rates, that should end. Right. That if it were up to me, I would actually have the Fed just be a lender of last resort in exigent times and have the Fed funds rate in some sort of band determined by the market. So I agree 100% that the Fed is not just some benevolent power. I also am a fan of Bitcoin, but I think that it's a bubble and that's going to burst, and that's not going to be what ends the Fed.
Right. Okay, now our final comment, it comes from, who do we have here? Thursday's show, and it's our story on the airline industry. It's viewer Halagonia who writes, quote, in the show's notes, did you really mean to say the airline industry has been notoriously volatile? I hope you meant to say it has been notoriously competitive ever since deregulation. A competitive airline industry is a great thing. It's what allows middle-class people to enjoy the convenience of air travel. Now, I want to say, yes, it has been notoriously volatile, and yes, deregulation has been a good thing for the consumer, but from an investor standpoint, it has been volatile, and it's not a good investment. I want to make that very clear that, yes, it's been volatile. Deregulation's good for people to buy tickets, but not if I wanted to invest in a company. Do you not agree?
I agree 100%. And, you know, Warren Buffett has said that it's a terrible investment. He would never do it again.
And he's pretty good at investments.
Exactly. And so that tells you it right there.
There you have it. That's all for now. Ed, thank you as always. But you can see all segments featured in today's show on YouTube at youtube.com/BoombustRT. We also love hearing from you, so please check out our Facebook page at facebook.com/BoombustRT. You can also tweet at us at AaronAid, at EdwardNH. From all of us here at Boom Bust, thank you for watching. We'll see you next time. Ciao.